people often talk about offshore tax structuring. They probably watched
Yeah,
The Firm or like other movies where
yeah,
there's some high flying guy in a private jet in Barbados, and they think, oh, this is just an easy way. I'll just move all of my money offshore, and so the tax man won't come after me. Is that the reality? Like, what's the actual boots on the ground reality of offshore tax planning in Canada?
yeah. That's a good question because I do get asked that question quite a lot. And I'll tell you that you may or may not remember a few years ago in the papers, there was this thing called the Panama Papers,
Hmm.
where there was disclosure of a company in the Caribbean that was holding a lot of accounts for businesses that were using offshore entities to bypass or escape tax liability that they would otherwise have been liable for which they would otherwise have been liable. And the thing about it is, at the time, there wasn't anything that these companies were doing that were illegal. In fact, there's a very ancient rule that we have in tax rule, the Duke of Westminster case, which states very clearly that you're allowed to do whatever you can within the law to minimize your tax liability. So as long as you follow the rules, and I think that's why the Income Tax Act is so big, is because people keep finding these loopholes, and then they have to create a new one addition to it to close that loophole. But then they find
Hmm.
another loophole, and then they have to add to it to create another loophole, and it just grows and grows and grows.
Yeah.
So Panama Papers happen. They a year or two goes by, and they changed a bunch of the rules to make it very difficult for people to just set up offshore. And one of the things that they did is they created this or bolstered this economic substance test. So before, there was a test about the central management and control. If the central management and control of the corporation is in Canada, Canada will have jurisdiction to tax. You could be incorporated on the moon. If the
Yeah.
directors and officers are here, Canada will tax it. But then they thought of an idea. Okay, you know what? We're just going to hire some directors and officers down there to be on the books, and we'll have one up here and the majority down there. But
Yeah.
then they thought, okay, you know what? We're going to force these other jurisdictions to put laws on their books, and we're also going to do that in our books. And we're going to create information exchange agreements, tax treaties with these countries to disclose to us who these people are, to prove that the economic substance, in other words, not just the people who are controlling the business, but that the business is actually occurring down there.
Mm.
So if you were a construction company, let's say, and you were having millions of dollars in revenues, and you just had your head office in the Caribbean in one of these tax haven jurisdictions, and you had two directors down there and one up here, that might have been enough under the central management control rule. But if everything you're building and all your offices are here and your sales office is here and in Canada and your construction equipment is here and you're building things here, the economic substance is really here.
Yeah.
So the only types of companies that are now good for this type of business model are companies that don't really have much of a physical presence. In other words, technology companies.
Right.
And so it would be hard, I think, for the tax authorities to close that loophole off. Because really what you'd be doing is, if you really have a technology company where the servers are actually in that jurisdiction and they have employees in that jurisdiction and developers who are all over the world who are working on this, but some of them in that jurisdiction, and you have
Yeah.
directors and officers in that jurisdiction, it would be kind of a hard thing you'd be encroaching on sovereignty at that point if you tried
Yeah.
to assert tax authority of one country over another, or if the economic substance and the central management control are both offshore. So you do
Sure.
have to meet certain criteria for this to work, but there are certain technology companies, and as you know, I work in the blockchain space and other technology companies, and a lot of them are good for this. But there's also this new OECD rule that's just getting approved, potentially for January 1st, with the global minimum income tax rate for these countries, which is saying that there's going to be a global minimum 15%, but it will only, from what I
Right.
understand, apply to companies with revenues of over 850 million euros a year. So
Okay.
a lot of our companies that we'll work with, which are usually in the 10 to 100 million a year range, will still be able to do this. These technology companies will still be able to do this without having to be subject to the global minimum income tax rate.
Okay.
So that's kind of the high level overview of offshore structuring. If you have questions about that, reach out if you think you might be a candidate for it. Most people aren't. Also, the cost of setting up and maintaining these things are substantial. So you want to make sure that your revenues and the tax savings substantiate the expense.